Now we begin with section E, which is going to be forecasting. So let us understand what is the meaning of forecasting first of all. In layman terms, or you can say in general terms, forecasting is simply the process, or you can say forecasting is simply to predict the future, or you can precisely say to reasonably estimate the future. In business terminology, in the accounting and financial world, forecasting is said to be that process through which the company tries to predict the future by making a historical analysis, by making a rigorous, or you can say by making an analysis of the historic trends of the company. So they try to evaluate the past performances, how it has been improving year on year, how it has progressed year on year, and based on that, they try to reasonably estimate, reasonably forecast the future. So in most of the cases, in most of the organizations, the forecasting of the company's goals and objectives is done by top management. The decisions flow from top to down. But as a project manager, it's also important for you to understand what is the process of forecasting done. How does it impact? How is the computations involved? How are the decisions made based on the various forecasts? Okay. So let's understand the need for forecasting in a project management. The very important first point is that project duration. It enables the entity, the project manager, to estimate the project duration, how long will the project exist, how long will it take to get completed, and so on. Now, project duration is crucial for any project manager to know because mainly, first of all, our resources are deployed for every period of time the project is continued. Salaries are paid, wages are paid, and so on. Next, it's a project cost. Once you have the forecast, you can estimate the project cost which is going to be involved throughout that period of time to complete this project, given the number of resources you need to purchase, maybe in terms of material, in terms of services, in terms of salaries, and so on. And the most important point is that it serves as a what if analysis. So the forecasting, understanding the forecast method helps you to figure out your own what if analysis. What if analysis means that what will be the impact of taking one particular set of action. Let's say, what will be the impact on the net profit if I increase the marketing spending by 25%? What will be the impact on my revenues if I increase a sales budget, salesman salary, salesman staff budget by 20%? What will be the impact if I increase my overhead spendings by 10%, and so on? So this is why it's important for you as a project manager to be aware of forecast. So let's quickly look at an example on how the forecasting works. That will give you a better insight on how the various functionings are falling into place. So let us from the example over here as we have been doing till now. So Mr. A as a project manager has received the following data for the previous year. So here we can say the revenue for the previous year were supposedly, let's say, 1 million. The cost which were incurred to get this revenue, they will be salaries of his staff somewhere around 200,000. Then materials, let's suppose it's a production kind of a thing, so what will be materials of 100,000. Overheads of his own department was another $50,000. Sorry. Then equipments, repairs. I'm taking the term repair over here because I don't want to involve any fixed asset acquisition as of now, because if that involves a whole lot of different depreciation and processes comes into place. I'm trying to keep it simple as possible so you can get a gist of what we're trying to convey over here. Equipment repairs might be around, let's say, 25,000 for the safer side, and other support. This includes everything, right? Another 25. So after all this thing, the net profit for his project was, let's see, revenue minus the cost involved, $780,000. Okay, so this is, oh well, that's, oh yeah, salary is supposed to be $200,000. That's what I was wondering. Why is it so less? Okay, so this is the budget of the previous year. Now let us say for the current year, it is forecasted that the revenue will increase by 15%, Salaries, because appraisals are expected by employees, will be increasing by 25%. Material by let's say 30% for the safer side, and other support will reduce. Let's see what the effect of reducing one of the expenses. Will reduce by 10% marginally due to the efficiency gain. Okay, gain over the period, over the past years. Prepare the forecasted income statement for Mr. A. So I'll just mention your actual. Okay, will be this income statement for the previous year. Right? After the income statement, we will mention here forecasted income statement. So over here, we'll just copy this previous year. We're going to have increase in revenue by 15%. So that's going to be 115%. Salary increases by 25%. So that's going to be salary into 5%. Materials will be increasing by 30%. So that's going to be 130%. Overhead remains the same. So that's going to be 50,000. Equipment remains the same. So that's 25,000. Other support is going to decrease by 80%. Sorry, by 10%. So that's going to be 90% of the original one. Okay, so this is how the forecasted income statement of Mr. A is going to look for the current period. Okay, that's going to be increase in revenue by 15%. That's going to be 1,015,000. Salaries increasing by 25%. That's an increase of $50,000. That's going to be 250,000. Material increasing by $30,000. Other overhead remains same. Equipment repairs remain the same. Other supports get reduced by 10%. So that's going to be 22,500 is the new overhead other support cost. Finally, it gives you an increase in the net profit. So if we were to compute this forecasted increase in the net profit, that would be the difference, that is 72,500 divided by $600,000, percentage of that, a 12% approximate increase in your net income, net profit compared to the previous year, previous forecast. So this is how you prepare the forecasted income statement, or you can say this is how the management prepares the forecasted statements. Obviously, it's not going to be this much simple, but the principles remain the same. They take up the past data and apply a fixed, you can say apply a percentage increase or decrease depending upon their analysis of the market, depending upon their analysis of the company's internal processes, improvements, and so on. Some cost will increase, some cost will decrease. In the inflation, not inflation precisely, in the years of growing economy, you can say the company expects an increase in sales based on the business models and expects a decrease in sales in some years, again, based on the revised market conditions. So now, if you're wondering when will the company reduce its sales figures based on the market condition, there are certain instances. Let's say, for example, before 10 years down the line, when Amazon was not there, there were only retail stores running across every corner of the world. At that point of time, every retail store will expect an increase in their yearly sales, year-on-year sales, a revenue increase year-on-year. But with the entry of the online markets, now the retail stores are reducing their year-on-year sales. Okay, the forecasted sales are reducing, the forecasted revenues are reducing. Why is that? This is because the change in the market scenario has become so much big that now online sales, online economy is booming, whereas the offline or the retail economy is going down day by day. So those are the scenarios which you need to account for when preparing the forecast. Obviously, as a project manager, it's very rare that you might end up doing the forecast analysis for your own project. Mostly figures flow down from top to bottom. But if you have the picture in mind, you can very well put up your case saying that if the management, let's say if you're running a retail chain, okay, if you're running a retail store, and if the entity has putted you a forecast on you saying that last year your sales was $1 million, this year you got to increase it by 20%. Now, based on your understanding, you can go ahead and say the management that because of the change in the economy, a 20% increase in the retail sales is highly not possible. However, if we move out, if we increase some of our spendings in the online marketing area, in the digital creation area, and then create an entire logistic supply or create an entire backend chain to make sure we are able to cater to the online market also and the offline market, then we might increase our sales by 30% with an additional increase on cost of 5%, or you can say in some cost by 10%. Based on those increase or decrease, you can prepare your own forecasted income statement and put up your case to the management. That also makes the entity know that you are an active project manager who takes an interest, who comes up with his own suggestions, who comes up with his own thought process of how the entity can prosper. So that was all, guys, with regard to forecasted income forecasting. In the next section, we're going to start with our budget and variance analysis, which is an extension that ideally the next step after the forecast are done. Now we begin with the next concept, that is budgeting. So once you complete the forecast, you have a reasonable estimate. And if you remember the last statement which we prepared in the forecast, that was a kind of a budget for the coming period, okay? So, but let's not go in such a vague term and let's understand clearly what is budgeting. So, precisely saying, budgeting comprises the estimation of the cost, setting up of an agreed budget, and lastly, managing the actual and the forecasted cost against the budget. This whole thing comprises a process of budgeting. The budget that identifies the planned expenditure for the project or the portfolio program. You can see the budget is going to lay out the expenditures in detail, what expenditures the entity expects to make to fulfill a particular project, to reach its goal of achieving that project. What are the costs which are going to be, various costs which are going to be incurred in reaching up to that project. It's a baseline, or you can say it is that standard against which the actual expenditures are going to be mapped, and a further analysis will be conducted. Why was the actual cost lesser or higher compared to the budgeted cost? And that terminology is the variance analysis, but that will take up in the next session. For now, understand this thing. The budget is a baseline, is that standard which you're setting up against which your performance, your actual performance is going to be benchmarked, is going to be compared to. So what's the importance of budget? So whatever is the importance of budget from the company's perspective, it's also important for you as a project manager. There's no deviation over here like we had in forecast, where the entity's forecasting objectives were different and it was a different objective for you to understand. No. Here, the entity's objective of preparing a budget and sticking to it are the same one as you as a project manager should have in mind. First one, obviously, cost estimation. That's a basic function of budget. It lays down the entire cost in detail one by one and gives you an entire summary of what is the estimate of the total cost which is going to be incurred for completing this particular project. Prioritizing the use of limited resources. Now, resources, they are always going to be constrained. They are always going to be a bottleneck for every organization, irrespective of how much of money the company has. There are certain exceptions to that rule, but in most of the cases, resources allotted to a particular project manager to a particular project are going to be limited. And you have to determine what's the best use to, or you can say, where is the optimal use of resources going to happen now. That's why it's important for you to prioritize the use of these limited resources. Which areas are going to be giving you more fruitful rewards, which are going to be more productive, more efficient, which are going to be less productive, less efficient, ignoring, or you can say putting those areas in the C category rather than diverting them in the A category. Next is the future planning. Now, future planning, don't get confused with this term yet. Okay, I know future planning was a part of forecasting. How is it ending up in budget will be a question in your mind. So once you have a project going on, an existing project, it's important for you to always keep a track of what's the expected cost going to come up, what's the expected budget going forward to complete the project. Okay, many times it happens that sometimes if a project is of 6 months and you had estimated a total cost of $100,000, by the time you reach only 1 month, you have already spent it $50,000. There can be tons of reasons for that, but yes, for the remaining 5 months you do need a good amount, and here this future planning helps you. How does it help you? It makes sure that you have a readily available amount, that what is the future needs going to come up, at which point of time how much funds are going to be required, and you can anticipate those in advance, prepare for those in advance, and make sure you have the arrangement for those funds prepared in advance. That's why the future planning concept is important, or you can say is a part of budgeting concept. You can say based on these things, you can understand that the company's objectives for preparing a budget are same as you have as a project manager. I'm not taking an example right now over here because I want to cover the example along with the variance analysis where we have a one single stretch, a full length example where we prepare a budget from scratch, compare it to the actual and dive a bit deep into the variance analysis. That is, dig deep. What were the reasons for the various changes? We can say the deviation from the budgeted cost. With this, we complete the theoretical part of budgeting, guys.